The Federal Reserve, as we've mentioned many times this morning, is set to announce a decision on interest rates that is coming at 2 p.m. Eastern time, so not that far away. Let's bring in two economists with different expectations on this. Joining us right now is Veronica Clark. She's Citi economist. She's expecting 5 consecutive 25 basis point cuts starting today. And then Mark Vittner, who is Piedmont Crescent Capital chief economist, says that the Fed might be better served by cutting in just 2 of the next 3 meetings. Okay, let's convene our own FOMC meeting here today. And I would like to welcome both of the members here, and either of you can state your case. Veronica, you want to lay your case out first for why you think they need to do 5 consecutive cuts here?
Yeah, absolutely. I think the labor market risks have clearly shifted since they last met in July. And this has been a labor market that is very gradually weakening for a while. We are experiencing deja vu. We saw this same time last year. And you would be worried that we are just ahead of that next step, which is layoffs. Why wouldn't you be at neutral at that point?
You said that you thought these cuts would have started earlier this year.
Yeah.
May?
Yeah, we were expecting that at the beginning of the year. Of course, we had the tariff risk, the Fed a bit more worried on inflation, and it took a while to see that weakening in the labor market, but I think we've clearly seen that now.
Mark, why do you think 2 out of the next 3 meetings will cut, 1 won't?
Well, I think
that they should, I suppose.
I think they need a fine balance. There's still a risk that tariffs are going to turn out to be worse than we've seen so far. And there's no question the labor market is weakening, but you're going to go ahead and cut today anyway. I think October is a game day decision. We see what happens with employment and inflation between now and then. And then I think it's also important that they get their messaging right, because long-term rates are really what's important here. The housing market is dead in the water. And if we don't get mortgage rates down, and we really need to get mortgage rates close to 6, what builders tell me, they really need rates below 6 in order to get housing going again. And you're not going to do that if you ease aggressively. If you ease too aggressively at a time when inflation's going up, long rates are going to go up, the curve's going to steepen, and you're going to accomplish more by doing less.
What do you think of that?
Yeah, I think it's a fair argument, but I think the way that we've seen the market reacting to the dovish labor market data that we've seen 10-year yields come down, and that's a market that's expecting the Fed to be cutting. Obviously, that's consistent with getting to something like 3%, which is what we're expecting, and that can be consistent with 10-year yields still coming down.
Neither of you have mentioned inflation. Do you not worry that that's a looming risk with the tariffs, or do you think that was overplayed from the get-go?
Well, I think it's a looming risk if the Fed eases aggressively, if they accommodate the tariffs, if they keep monetary policy modestly restrictive, then if consumers have to spend more on imported goods, they have less to spend on other things. And that's essentially what we're seeing right now. We're seeing that services prices, for the most part, are moderating. We had a little bit of a hiccup last month, but just a little bit of one. And people are spending less on services which are domestically produced.
But they're not spending less, so it means they're spending more on the goods that they're buying.
They're spending more on goods, and since they're spending more on goods, they have less to spend on everything else. And you think back to the 1930s when we had the last time we had tariffs approaching these levels. 75% of what we bought were goods, 25% were services. Today, 2/3 of what we buy are services and 1/3 are goods, only part of which are subject to tariffs.
All right, let's just throw some anecdotal evidence into the mix. Scott Kirby, the CEO of United Airlines, was on yesterday. One of the things he was talking about yesterday is that we did see a slowdown in the consumer, but that a light flicked at the end of June. Basically, the light switch went on and consumers started spending again and started traveling. What does that tell you about the nature of the downturn, the potential downturn, but the willingness for the consumer to spend if they can?
Yeah, I mean, we've seen this for a while now where the labor market is very gradually loosening. We saw the slowing in spending earlier this year. There is this story, this possibility out there that maybe there was just this temporary uncertainty. People were worried around the tariff announcements in April. They just pulled back temporarily, and we'll get this rebound later this year, and that's possible. But the fact that we've seen this loosening in the labor market for 2 years already tells me that is not improving. Until I see hiring picking up, I would be worried that we could get a bigger crack in the labor market, and if people are losing their jobs, then they cut back on spending.
Some people argue this away and say that this is a matter of a smaller labor pool because we don't have immigration coming in and we have people actually leaving the country.
Yeah, I think that's a big role in what we're playing a big role in what we're seeing. But there is no question that businesses are pulling back from hiring. It is a tougher environment for college graduates. It's been a tougher environment for them to find a job, and so there is a significant slowing in the labor market. But I don't know that it's as fragile as it appears because of the pullback of foreign-born workers.
Mark, I want to go back to something you said about the housing market, because we had the Treasury Secretary on yesterday. Scott Bessent said that is the thing that they are most interested in fixing, is getting the housing market moving again. You really think if they cut aggressively that will, undo any good that they're potentially doing, because the long end won't follow along?
Yeah, well, we saw that in the cuts a year ago.
Yeah.
And I think that if the markets feel that the Fed is getting ahead of itself, and that it's leaning too far on one side of the mandate, then I think that we could see that long rates would rise. And it really, if we had one or two very disappointing inflation numbers, that's all it would really take. And so I think it's important that they get the messaging right. And housing's not going to turn on a dime, because we have this huge buildup in inventories of new homes. And it's the highest it's been since 2007. And so they need sales to pick up so that we can clear out some inventory. We still have a lot of work in progress as well.
Pick up our prices to come down. I mean, if the inventory is there and you have buyers who want to buy it, just not at that price, you can either adjust the mortgage rates, or the builders can take a haircut on what they thought they were going to get.
Well, there too,
they're not willing to do it yet.
There too, we need to find balance. I mean, there are essentially cuts taking place, in that you are seeing that the builders are buying down mortgages still, and they're offering incentives almost every.
It's weird though, Mark. So you stand pat, you let the labor market continue to weaken, and that's how long rates come down. You can't cut rates. Let's raise rates.
Let's
raise rates so that so that long rates come down.
No. You don't cut rates aggressively. You find the right balance. You cut rates
really
in September.
Based on inflation.
And so
it's
really
based on what happens with near-term inflation.
But what we're talking about really is the dot plot, and we don't have 5-6 rate cuts in the dot plot. We have 2 this year, maybe 1 or 2 next year.
Right. Okay, it's weird. Cut rates and rates go up.
Well, we've got very recent experience with that.
You wonder why people look at Wall Street and go,